Hey traders, Nick here looking at FedEx. So the question came that CNBC Jim Cramer said FedEx looked like it bottomed. I've been tricked by this one before. So let's see if he's got reason to believe that and if we agree. So looking at it, okay, double bottom potential, but it dips. It's not entirely clear that this is not just like the other bounces that failed. I felt for the last 6 months, 8 months that I'm missing a piece of the puzzle for FedEx. I used to be very consistent with guessing. Now I guess the ranges, but it's a heartbreaker. When you think it's going to do this, it does that. So there are some levels that are important. So let's talk about the support on the bottom. Oh, first of all, his thesis is that they came out with a negative note overnight, yet it still rallied. It's up 1% on the day, 612 today, when markets were red. So usually, okay, I'd say that's a valid point, but the note still they lowered the price target down to 190. 190. It's way lower than 190 now. So, and they maintained their outperform rating. It just doesn't make sense. So I'm going to believe the price action more than the actual reason for it. So let's see. Longer term, I don't like it that I only see one of these. I'm going to expand the time frames to 5 years. In fact, I'm going to make it all the way to 20 years. So this is 1999 on. So I'm zooming in. These are monthly candles, so pretty low. Every candle is 1 month. So take that into consideration. So let's spot the current level. So this is where it's at. And he's saying it double bottomed. I'm saying this is a level of contention that dates back a long time. So this zone should be support. This should be bulletproof. Look at this. I mean, how perfect is that? Right here, right there, 2007. Remember that period of time? They took all this time to come back, and then boom, above it, and then support, and then off to the races. So this is support 1 that we're talking about right here, and this is absolute bulletproof, 120. So these are my big thoughts. So when he's saying it bottomed, I can't disagree totally, but the proof is in the pudding. And I would zoom in, say 120, and say that, okay, there are some lower time frames I need to consider. And the range is tightening from this wide into a point. These are 2-hour candles. Something's got to give, either this or that. And if this, then my first bug out number would be 158.30. Second bug out area is 155.90, so let's call it 156, 155.75. And there's a little tiny gap down here. I don't know what that's all about. 150.75 below is definitely out. So it depends on how much tolerance I have to see red when I'm long something. These will be short-term bug out numbers. On the upside, the potential is the moon, obviously. These people told you they downgraded it to 190, which is way up here. So there is going to be resistance where? Right here, which is 163.80. This is definitely a resistance level right there, 168-ish, because this was a ledge from which they fell apart. They pulled a battle here. So I'm confident that 159-ish, plus or minus, it's a zone. It's been a point of interest, point of control, technically speaking, for a while, for as much as we're looking at the screen. So this is April on. So they tend to be sticky. So on the way down, they tend to be support. So here we are at them. So to go far away from them, they need another piece of bad news. Now, I don't like this because it tells me this might happen. So I have to keep that in mind, that I have to live up to my stops. So, okay, I agree that this could be a bottom. The reasons we might argue about the reasons why. I think the recommendations that the analysts give out are just complete garbage. Unusable. Let's put it this way, from a trading perspective, okay? For my purposes. All right, so how do I go long? Number one, people can buy shares, stock. If somebody wants to get long something, they buy a stock. They spend $162 right here per share, and you're long. Conversely, I can use the options market. Now, bang for the buck, the options market is unbeatable. If I guess the right direction, the stock is up 1%, and the options are guaranteed to be up more than 1%. Let's put that to the test. I'm going to switch. This is FedEx. I'm going to go to June. So today the stock was up, where is it? 1.21%. Outstanding. If you bought it yesterday, you made 1% on your money. Well, if you bought the options yesterday, you made 30% on your money. So it's better bang for the buck. It's fact. You have to guess right because they go away just as fast. So whoever bought puts, they lost 30% of their money. So that's the little trick there. So I can buy the shares or I can use options. So how do I use options? Everybody likes to buy. And people scare you by saying, oh my gosh, 80% or whatever that number they throw out there of options die for zero. So everybody loses. I challenge that statistics. First of all, I hear many forms of it. Second of all, do they consider spreads? Because if I take spread by design, one will lose, one will win, and I may still win. So, I don't like statistics like that. Besides, there are plenty of ways of making money even with that statistic in mind. Okay, so I can buy a call or call spread or call calendar, which is also a spread but not a vertical spread. What's the difference? I've done a whole bunch of videos on those. The idea is I either buy a call naked, unhedged, or I buy a call and then sell a call above it, so I make it a vertical. Or the calendar is I buy a call and instead of selling the call above it, I'll sell the call next to it closer in time. So if I buy a call out to September or October, I can sell June's against it, and this way if it expires worthless, then I lowered my entry cost and I'm long for cheap the other one that left alive. So that's one way. So if I'm buying, I'd like to incorporate an earnings report. I do believe they have an earnings report coming up soon. When is that? Sometimes late June. So I want to be out at least in July when I buy a call, because when I buy premium and it includes at least one event like an earnings report, then it tends to hold up its value better because there's a spike in implied volatility because there's an event, as long as you're not too far out, because then that event becomes useless to it. For example, if indeed it reports late June, if I buy early July calls or puts, they're going to be super expensive relative to normal because of the implied volatility, right? So this is just an idea. So is there another way that I can go along the stock for free? Yes. So since I don't know what the heck is going on with FedEx, but I do know that it has support, and I do know that if it falls further, it has even better support, then I'd rather sell puts or put spreads to generate income without even having to sweat the short term. How does that work out? Okay, so now to recap, I agree that there could be a tradable bottom here with tight stops. Buy calls versus buy stocks. Either way, I'm spending money out of my pocket now and hoping for a rally. There is a way to profit without any hope of a rally. In fact, it can still fall 7 to 10%, and I still won't lose money. How does that work out? Okay, this is where the lesson starts. Quick lesson in puts and how to be the market maker and sell puts. They say most options expire worthless, so why not sell them? The sellers are making money if that's the case. So let's go to January. Why January? I don't have to worry about it for a while. 219 days. I can fight with binoculars. Why be in the trenches? Okay, so if something goes wrong here, I can fix it. I have time. All right, so we spoke about the 140 level. I picked it. I could go lower. Technically, usually I go lower. So looking at this, the options market for that month in January, they are expecting about a $30 move plus or minus, meaning they expect either 130 or 190. They're saying these two are within the realm of possibility. How do I tell that? It's just basically the cost of the straddle. How much does it cost to buy the calls and the puts at current price? It's about that much. So anything outside of that, if I'm buying a put higher than lower than 130 and a put higher than 190, my odds are really, really small. Okay. So how does that work? let's say somebody out there owns FedEx stock and they want to buy insurance for anything below 140. What does that mean? They're okay seeing red until 140, and then they want to get the heck out. So I do my homework and I say, you know what, 140 brings it to a support zone that I'm comfortable owning FedEx. This would be my statement. And I would say, okay, I'll sell you that insurance. And how does that work? They pay me the $7 premium, a little less. I'm going to use 7 for round numbers. That money goes into my account today. So $677, $700 because I'm using 7 for every contract because it's 100 shares. Goes into my account today. This is not my money yet. Think of it as a service that I haven't delivered yet. I collect it, it becomes a liability, on my balance sheet, so to speak, until the service expires, which is what? Which is me covering the insurance through January. So I'm basically saying, hey, pal, don't worry about it. If the stock falls to 135, I'll buy it off your hands at 140. They say, sweet, I can sleep tight. So my break-even point becomes 133 because I collected $7, correct? And I take it at 140. Anything below 133, I start losing money. That's how it works. So I'm on the hook from 133 to 0 with losses. If it goes to 0, I lost $133 per share. So this is the maximum loss. How can I limit that? I can do a credit put spread, also called a bull put spread. Still a bullish statement, but instead of me taking on the full burden, I'll say, you know what? I'll sell him the $7, but I'm going to pay $5.50 to stop my losses at 135. So here I collect $1.35. I'm doing area math here, so don't sue me. On a maximum width of $5, so my maximum risk is the difference between the two. I'm going to use 350 and 150 just for ease of math. So I'm basically yielding about 30%, if not a little more, in potential reward to the risk at hand, because the maximum I can lose is $5 less what I collect. So this would be a bull put spread where I say, okay, I'll cover you at 140, but I need somebody to take them off my hands at 135. Somebody does their homework and give me the same policy at 135. So if nothing happens, or if it falls but stays above 140 by 1 penny, I won. Full blast. Maximum. I generated $7 out of thin air if I sold it naked. So the stock fell from 160 to 140. Those who bought the shares today, they suffered $20 losses. Me, I made $7. So what if the stock rallies to 200? Okay, so they outdid me because my profits stop at 7, so 167. Anything above that, they're outdoing me. But if it starts moving up, I can add calls. So I got $7 to play with. I can buy calls or call spreads. So this is how it works. I sell a put. I'm basically selling somebody either a lottery ticket that they think it's going to 140 and they want to bet against it and they buy the lottery ticket and hopefully they lose. Or I sell them insurance. They really just want to sleep tight because they own the shares. In that case, hey, sleep tight, my friend, I got you. That's how selling put works. So again, this whole video is to share a starting point on how one would sell puts. Now, it's very dangerous to go out there and selling puts all over the place, especially when markets are at all-time highs. So definitely I expect questions and I would do a lot of homework. Specifically the FedEx, this is not my idea. The idea came from Cramer that it bottomed because it's rallying on bad news. So his idea is if the stock cannot fall on bad news, but I question the badness of this bad news. So let's read it. KeyBank cuts FedEx price target to 190 from 215. They restate that they're overweight the stock. So how is that bearish? I don't know. It's not bearish. They're still overweight the stock, and they're recommending it as an overweight, meaning they expect good things. All right. A little earlier, Credit Suisse cuts FedEx. That's yesterday. Price target to 184 from 241. On macro headwinds, keeps outperform rating. So they cut it down to 184, which is still 20 bucks, 23 bucks higher than now. They kept it as an outperform. Garbage. This is garbage. How can somebody listen to this? I bet you they recommended it at the highs. I don't have time to go back and look at it. They probably recommended it at the highs. So, excuse me. So this is what Yahoo says about the analysts. June, May, April, March. So how they're moving their recommendations. So we had a few holds. Now we have, looks like, more holds. We have one less strong buy, but most of them are still buys. Buys are strong buys. So it's trading at their average price target is 205, 206. Now it's 162. There's as high as 380 and as low as 136. Hey, that's a good number right there. Nobody expects it to go much below 140 that I just picked out of the blue. So clearly, this whole video was not a waste. It's a long video because it's an educational piece, especially on the fact that somebody can make money without having to wait for a rally. When I sell a put, I don't need a rally to make money. All I need is nothing to happen. In fact, the stock can fall 7 to 10% in this case, and I'm still green-ish. If you have any questions, let me know. This is longer than I wanted, but I just couldn't. I recorded it twice. The first time was heck a lot longer.